Did you know that if you had invested just $100 in Amazon's IPO in 1997, your investment would be worth over $120,000 today? Shocking, right? But that's the power of compounding assets, a strategy that has turned ordinary people into millionaires without winning the lottery or inheriting a fortune. In this video, we're diving deep into the 6 best compounding assets to start investing in now. From the bustling stock market to the steady growth of real estate, the secure returns of high-interest savings accounts, and even the wild world of cryptocurrencies, we've got you covered. We'll explore how you can start small but think big, turning your hard-earned money into a self-growing wealth machine. Imagine turning a tiny seed into a towering tree with branches that stretch out far and wide. That's what compounding can do for your investments. And the best part? It's not rocket science. Whether you're a seasoned investor or just starting, we'll show you strategies that are easy to understand and even easier to implement. Stay tuned as we reveal how to pick the right investments that grow over time, share insider tips on maximizing returns, and unveil the common pitfalls to avoid. Your journey to financial independence starts here. Let's unlock the door to a future where your money works for you, creating a legacy of wealth and security. Welcome to the world of smart investing. Chapter 1. The Power of Compound Interest. Imagine a snowball rolling down a snowy hill. At first, it's just a handful of snow, but as it rolls, it picks up more snow, growing bigger and faster. That's compound interest in the financial world. Simple at the start, but massively impactful over time. Compound interest is the interest on your investment, plus the interest that has already accumulated. In contrast to simple interest, which is just on the principal amount, compounding can turbocharge your savings, turning modest sums into mountains of wealth over years. Let's dive into a bit of history. Did you know that Albert Einstein reportedly called compound interest the 8th wonder of the world? He said, "He who understands it, earns it. He who doesn't, pays it." Whether he actually said this is up for debate, but the sentiment holds true. The concept of compounding has been a key wealth-building tool for centuries, appreciated by the wisest of investors. Here's a quick comparison to highlight the difference. If you invest $1,000 at an annual simple interest rate of 5%, you'll earn $50 each year, no more. However, with compound interest at the same rate, your earnings are reinvested. So, in year 2, you're earning interest on $1,050, not just the original $1,000. Over 20 years, that difference is monumental. The magic really happens when you play the long game. The longer your investment compounds, the more substantial the rewards. It's like planting a tree. Initially, growth seems slow, but given time, that tree becomes a towering giant. That's why starting early is crucial. Even small amounts can grow significantly over time, thanks to the relentless power of compound interest. Chapter 2. Stock market investments. When it comes to compounding, the stock market is akin to fertile soil for your money tree. It offers a potent blend of growth potential and income through dividends, making it a premier choice for investors looking to capitalize on compound interest. First, why stocks? Over the long term, stocks have consistently outperformed other investment classes like bonds and savings accounts. They offer a share in the growth of companies and, consequently, the economy. It's not without risks, but the rewards can be substantial. Picking the right stocks is more art than science. Look for companies with strong growth potential, a solid business model, and a track record of performance. It's not just about buying low and selling high. It's about holding on to companies that can grow significantly over time. Here's where it gets exciting. Dividend reinvestment plans, DRIPs. Many companies pay dividends to their shareholders, which can be automatically reinvested to purchase more shares. This automatic reinvestment accelerates the compounding process, turning your investments into a self-feeding engine of growth. Consider the case of a company like Apple. A decade ago, investing in Apple would have seemed like buying a decent stock. Today, That investment, especially with reinvested dividends, would have grown exponentially, showcasing the power of compounding within the stock market. However, it's not all sunshine and rainbows. The stock market can be volatile and not all investments pan out. Diversification is key. By spreading your investments across different sectors and asset classes, you can mitigate risk while still benefiting from the compounding growth of successful stocks. Chapter 3. Real Estate Investments. Real estate investment stands as a formidable pillar in the realm of compounding wealth. Unlike stocks and bonds, real estate offers tangible assets, properties that can be rented out for steady income or sold for profit due to appreciation. It's a dual engine of earning through rental income and the natural appreciation of property value over time. Why real estate? It's not just about owning a piece of land or a building. It's about securing an asset that historically appreciates in value, providing a hedge against inflation. Plus, rental income can be a stable source of cash flow, which, when reinvested, compounds wealth significantly. Getting started might seem daunting, but you don't need to be a millionaire. Options like real estate investment trusts, REITs, allow investors to pool their money to buy properties, offering a slice of real estate income and growth without the need for direct property management. For those looking to dive deeper, purchasing a rental property can be a more hands-on approach, offering greater control and potentially higher returns. The secret sauce of real estate compounding is leverage. Using a mortgage to purchase property means you're using a relatively small amount of your own money to control a much larger asset, amplifying your investment's compounding effect as the property value grows. However, it's not without risks. Real estate markets can fluctuate, and properties require maintenance. Plus, being a landlord isn't for everyone. It's vital to research thoroughly, perhaps focusing on areas with strong rental demand and potential for appreciation. Chapter 4. Bonds and Fixed Income Securities. Bonds and fixed income securities are often viewed as the more conservative siblings in the investment family, offering steadier, less volatile returns. They're essentially loans you give to governments or corporations, which pay you back with interest. The compounding comes from reinvesting these interest payments, growing your investment steadily over time. Why invest in bonds? They add balance to your portfolio, reducing volatility and offering predictable returns. Especially in turbulent market conditions, bonds can be a safe haven, providing steady income when other investments might be losing value. Diversity is key in the world of bonds. From government bonds, which are considered very safe, to corporate bonds, which offer higher yields but come with higher risk. There's a spectrum to choose from. Municipal bonds, another option, can offer tax-free interest, making them particularly attractive for investors in higher tax brackets. The compounding effect in bonds is more subtle but equally powerful. Reinvesting interest payments into more bonds increases your income over time, harnessing the power of compound interest in a less volatile environment than the stock market. However, interest rate risk is something to be mindful of. When interest rates rise, bond prices typically fall. Long-term bonds are particularly sensitive to rate changes. Diversifying across different types of bonds and maturity dates can help mitigate this risk. Chapter 5. High-interest savings accounts and CDs. In the world of investing, not all strategies involve navigating the ups and downs of the stock market or the complexities of real estate. Some of the most straightforward and safest ways to start compounding your wealth are through high-interest savings accounts and certificates of deposit, CDs. These financial instruments offer a no-frills, almost guaranteed return on your investment, making them an essential part of a balanced portfolio, especially for risk-averse investors. Why choose savings accounts and CDs? The beauty lies in their simplicity and security. With FDIC insurance covering up to $250,000, these savings vehicles provide a safe haven for your capital while offering returns that, although modest, are guaranteed. They're an excellent place to park emergency funds or short-term savings where the risk of loss is virtually non-existent. Understanding the returns, interest rates on savings accounts and CDs have historically been lower than those you might achieve through more aggressive investments. However, in a rising interest rate environment, they can become quite attractive. Compounding comes into play as the interest earned is added to the principal, and over time, even these modest rates can contribute to your wealth. Chapter 6: Cryptocurrencies and Digital Assets. The world of cryptocurrencies and digital assets is the new frontier in investment opportunities, characterized by rapid growth and significant volatility. For those willing to navigate its uncertainties, the crypto market offers a unique chance to participate in a global, decentralized financial system, where the potential for compound growth can be astonishing. Why invest in cryptocurrencies? Beyond the allure of high returns, cryptocurrencies offer diversification away from traditional financial assets. They represent a bet on the future of finance, embracing technologies like blockchain that could revolutionize how we think about money, assets, and transactions. Compounding in the crypto world differs from traditional assets. While most cryptocurrencies don't offer dividends or interest in the conventional sense, compounding can occur through strategies like staking or participating in decentralized finance, DeFi protocols, where your crypto can earn returns, further increasing your holdings.